Good morning, YouTubers. For Friday, Good Friday, April the 10th, I just thought I'd do a video on the market action last week. I think we saw the strongest increase in the markets, I think going up about 14%. Which is the strongest rally I think the markets had seen in about 40 or so years. They're going to go back to 1974, 1975. Of course, it is whipping a lot of people around, even myself. As I've mentioned, I have short positions and long positions. And though the news coming out, which I will get to, is still extremely bad and getting worse. To a lot of investors, the rally made no sense. But as I've said before, it's the old "don't fight the Fed." So what we did see, of course, the Federal Reserve unveiled an array of programs Thursday that it said it would provide up to $2.3 trillion in loans, expanding the Fed's operation to reach small and mid-sized businesses in U.S. cities and states. So now we've got the monetary side, which is the Fed printing money to buy assets. And we also have the fiscal side, the government, that's going to be sending out, I think, checks of $1,000 to all the people in America, plus other policies. And this kind of, I think, is short term. It just kind of overrode all the bad news that continues to come out. Of course, a lot of people now are thinking we're in a new bull market, we're going to go on to new highs. I still think this is a bear market rally, and the market will turn around and go lower. I have kept my short positions in that belief. Last week was a bit of a wash for me because I did buy some more long positions, which I will get into, and but the gains on my longs were kind of taken away from the losses on my short positions. So it was a little bit disappointing. In hindsight, I probably could have traded a little bit better, buying more long positions, which would have increased my gains on the week. But the long positions I did get, I still held a pretty conservative position on them. But one thing I find, which has been a trend I've talked about, going back several years now in my videos, is we're seeing a further deterioration in the Fed balance sheet. Before, 60, 70 years ago, the only thing they would buy would be government treasuries. And now, during the 2009 financial crisis, they expanded that to mortgage-backed securities, basically bailing out the banks that made bad mortgages that should have never been made. And now, this is from the Wall Street Journal, we see the Fed has also expanded previously and announced corporate lending programs to include some classes of riskier debt that have been excluded, including allowing firms that until recently have been rated as investment grade to participate in those facilities. So what they're doing, so one, corporate credit backstops to support new debt issue of highly rated firms, which is what initially how this started, to be expanded to include so-called fallen angels. That's where the investment grade in mid-March has been downgraded from investment grade, and now the company's been downgraded to a triple B or B rated. And And a second corporate backstop will allow a limited amount of purchase of non-investment grade debt in exchange traded funds. So again, we're just seeing them do the same thing they did in 2009. Now they're looking at all corporate debt, even companies that really should go bankrupt, they're going to buy their debt just to keep them going. So Fed continues to increase moral hazard as it did in 2009 financial crisis, adding mortgage-backed securities to its balance sheet, using a big broom to collect mortgages that never should have been made in the first place. So now we're using that same broom to buy all these loans that, in effect, companies should just go bankrupt because they're probably not going to be viable even if things turn around in the future. So this comes down to a word that's used in finance a lot, and it's moral hazard. So moral hazard is a risk to the party that has entered into a contract in good faith or has provided misleading information about its assets, liabilities, or credit capacity. In addition, moral hazard is also may mean a party has an incentive to take unusual risks in a desperate attempt to earn profit before the contract settles. Moral hazard can be present at any time two parties come into an agreement with one another. Each party in a contract may have the opportunity to gain from acting contrary to the principles laid out in the agreement. But this is the part that of moral hazard that we're seeing now more. It says any time a party in an agreement does not have to suffer the potential consequences of a risk, the likelihood of moral hazard exists. So now we're going to have more and more businesses that will do riskier and riskier things, thinking that if things go bad, the Fed's just going to come in and buy their debt and keep them going, especially if they're a bigger corporation. And this just totally breaks down the capitalist system where we use the market system to allocate scarce assets, resources, to companies that the market feels are going to be the most efficient and prosperous. Now people with any idea can just go out and get a loan and then not worry about the consequences, maybe of paying it back. So it changes the whole mindset of the economy. And I think the United States, as more and more of this debt gets bought up, it turns the United States into a socialist country, because more and more of the assets will be indirectly owned through the Fed and the government. And we just know that governments aren't as efficient as allocating cash as the free market is. Of course, government does have a role to play in society, and a good government, and I'm not totally against the actions being taken right now because of the severity of the coronavirus, but it's the coronavirus that is just allowing them to carry on the habits of the past that are probably going to make this coronavirus economic impact worse and have continued downward effects on the capitalist free market system that will persist maybe a lot longer than the virus itself. So again, contrary to what the market did last week, we saw unemployment benefits applied. 6.6 million Americans applied for unemployment. I think the week before was like 5, so we're quickly getting up to some numbers we probably haven't seen since the Great Depression. And this is from a U.S. economist. So there's lots of uncertainty at the moment, said Andrew Hunter, a senior U.S. economist at the Capital Economics. Everyone's been surprised at the speed and scale of the layoffs, but market rallied 20% over the week, mainly from the injection of government and Fed money. But again, the average person just trying to pay their rent doesn't benefit from this. So there's lots of people, again, that aren't benefiting. With this cash injection and markets going up, we're still seeing the richer people in society being rewarded again. And it's just making things, I think, worse in the long run. Any good democracy needs a strong middle class, which has just been getting smaller and smaller in the United States. And I noticed with all this money printing, you got to start to compare it to other assets. The dollar index, which is the US dollar divided by the euro and other currencies, did strengthen at the beginning of this, but it did come down last week on the announcement of this. Also, as another indicator, we see gold last week go through $1,700 an ounce for the first time in a couple of years.